Hey Conrad, it's reporting that Clariant, the first quarter is over. So let's start with an overall assessment of the results. What do you see for Clariant happening here?
Yes, good morning, Kai. We delivered at Clariant resilient results in what became a very challenging environment towards the end of the quarter.
So yeah, first of all, on the sales side, obviously we all know the Middle East crisis hit us in the middle of the quarter. So let's start with that. What's the impact here?
Yeah, if you look at the overall sales, we were at minus 2% in local currency. It's important to note that we did a fair amount of pruning activity on the portfolio last year. If you correct for that, our sales was basically largely flat for the first quarter. The Middle East impact only started in March, but did have already an effect primarily on our catalyst business.
Okay, that's a good starting point. So catalyst business. So tell us a little bit more what happened here and how you see the situation.
Yeah, if you look at our catalyst business, the impact of the Middle East is severe. We have at the moment in that industry 88 companies on force majeure or shutdown, 44 active customers in our catalyst business are impacted. That represents in total in the first quarter for us already 5% of revenue.
Okay, then maybe a quick comment on the other two businesses. So Care Chemicals partly affected, Adsorbents and Additives not that much. So what are the results looking like here?
Yeah, if you look quickly at the results by business unit, Care Chemicals, we were actually up in volume 3.5% if you correct for the pruning activities that we did last year. We saw positive growth in our mining business, positive growth also in personal and home care. If you look at Catalyst, overall minus 1.6% growth. Correcting for the 5% impact from the Middle East, we actually would have been up in Catalyst. So we actually were having a good start of the year in Catalyst until the war broke out in the Middle East. Then finally, Additives and Adsorbents. Here we had slightly negative sales growth. This is primarily the delay in the implementation of the new EPA directives for renewable fuels. We are expecting a pickup of that business in the coming months.
So I see that there are no structural issues. You mentioned it, delays and short-term effects, obviously. How does all that translate now into our EBITDA margin?
Yeah, first a quick comment on your question about structural effects. So what we expect in our base case is for the Strait of Hormuz to open again by the end of June. That would mean that customers that currently are impacted, and that is not only in the Middle East, but also in Asia, where there is feedstock shortages for some of our customers, we expect a recovery starting in the second half of the year. As far as EBITDA, what we see is we were down 130 basis points versus prior year. That's primarily an effect of the lower EBITDA in Catalyst. We were missing highly profitable sales into the Middle East, but we also had some one-time effects related to low margin revenue for precious metals. The second business that was down slightly from prior year, Care Chemicals, this was primarily an inventory devaluation effect. We saw raw materials coming down actually in Care Chemicals compared to last year. And we also saw a slightly unfavorable mix in our Care Chemical business.
How have our cost programs helped to mitigate the risks of losing EBITDA margins?
Yeah, I think it's an important comment. We are maneuvering in a challenging environment. I think what is important is our value-based pricing to offset increases in raw material costs. But what is also important is the benefits from the different cost improvement programs over the previous years. And the program that we started last year, an 80 million Swiss franc per annum cost improvements. We still have a benefit of 30 million to come from that program this year. And it was very encouraging to see that in the first quarter, we delivered already 9 million savings out of that 30 million additional benefit to come in this year.
So we're well on track. Thank you for elaborating on that, Conrad. Now, before we talk again about the Middle East and then look into the future, let me get back to what you said with our full year results, because you mentioned that innovation is important for our strategy implementation and execution. Now, with all the short-term challenges, I can imagine that not everybody's talking about innovation necessarily. Nevertheless, can you report some progress at this end as well?
No, it's great to see that we're not only managing the short term, but also the long term. And I'm very pleased that we achieved almost 20% innovation sales as a percentage of our overall sales. It also was very nice to see the prestigious awards coming in. We won prestigious innovation awards at In-Cosmetics in Paris. We also won 2 prestigious innovation awards at China Plast. And one I like to call out, and that is the PFAS-free processing aids that we're now have developed and are selling. This is actually a PFAS-free solution for processing aids, which actually means that we can do food packaging, all kinds of critical applications without PFAS now.
Yeah, great news, and congrats to all the teams involved, of course. Very last question on Q1. We have a very strong cash conversion rate, Conrad. So what are the reasons behind that?
Yeah, we were very pleased with our cash conversion rate, a new record high, 54% conversion from EBITDA to cash. That was up 12 basis points from before. Yeah, the main contributor here is working capital management. We got more than 100 million cash release from working capital management, which is a big compliment to the team.
Great achievement indeed. So before now talking about the guidance, Conrad, let's look at the current situation in the Middle East. And maybe on a personal note, many of us at Clariant have colleagues, friends, or even family in the region. So can you first talk about our situation, how we're impacted, and how our people are doing?
Yeah, thanks for that question, Kai. We have about 100 colleagues on the ground spread over the different affected countries in the Middle East. We also have almost 50 people in our joint venture in Saudi on the ground. Everybody's safe. Also, since we have now the ceasefire, everybody's back to working again. So we're very relieved by the ceasefire, which is now lasting for a month. I still would like to say for business to recover, it is important that the Strait of Hormuz opens, because we still have customers on shutdown, on force majeure, because they either cannot supply their finished products through the Strait of Hormuz, or they cannot get feedstock to their plants. So this is the next step, which in our base case, we assume will happen before the end of the first half.
Definitely. So this is our assumptions. However, it's not in our hands, as we know. Nevertheless, we have taken some measures to mitigate the risks, thinking about the many customers that are affected. You mentioned that, but also on the cost side, input costs. What do we actually do to mitigate all these risks related to the Middle East crisis?
Yeah, first on revenue. In our base case, we expect a reopening of the Strait of Hormuz. We expect a recovery in the second half, primarily affecting the customers in catalysts that are now on shutdown or having declared a force majeure. What is very important is the shortages have triggered a wave of inflation. The shortages in combination with the high energy prices. So we see, for example, ethylene now at monthly contract pricing published 1,700 euros per ton versus a pre-war number of 1,100 euros per ton. So what we do is we are applying our value-based pricing. We deliver significant value to our customers, and by and large, we feel we're able to pass on the increases in our raw material, energy, and freight costs to our customers. Secondly, also important, the cost improvement programs. I mentioned it already. We benefit from that. There's additional savings coming in this year from these programs, and that helps us to overall deliver still our guidance for the year, which is around flat revenue and an EBITDA margin around 18%. That's very much based on pricing, value-based pricing, and continued benefits from our cost improvement programs, offsetting for higher raw materials, offsetting for some sales losses.
So guidance remains unchanged despite all the challenges. I think this is our takeaway message for today. Yeah, thank you very much, Conrad, for all these insights. Wishing you and all of us all the best, and we will talk again very soon.
Thank you, Kai.